I'm bullish on assets because I believe the governments will always have to print money. And we could see some selling, but I think any type of selling that we'll see in the market overall broadly will be swiftly met with more money printing and more stability. The whales, what we call the smart money, they're buying the dip. I think this is a great time to add to your bags, to buy the dip. I'm certainly a buyer at this range.
We are currently observing a distinct anomaly in market structure that separates retail sentiment from institutional reality. Recent price action reveals a pattern of structured selling, specifically occurring around 9:30 in the morning Eastern Time. This is not organic bearish momentum. Rather, it indicates distressed market makers unwinding leverage and forced liquidations hitting the books. What is critical to note is the divergence in technical indicators. We are seeing the lowest daily MACD reading in history, yet Bitcoin is only down roughly 33% from its all-time highs. In previous cycles, such technical readings were associated with 80 or 90% drawdowns. This suggests that while we are seeing a massive algorithmic flush of over-leveraged positions, the underlying asset is showing remarkable relative strength. The market is absorbing this distressed supply, setting the stage for a significant reversion as the selling pressure exhausts itself.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
Well, what happened is you have these major market makers and blowing up. And so then what happens, they have to unwind these positions. And I saw this chart this morning on Twitter. It looks like every single morning at 9:30 a.m. Eastern, a big seller is coming to the market and dumping Bitcoin into the market. And so what that is it's structured selling. Somebody's trying to unwind a position. Healthy markets wouldn't do that. And so somebody is showing up every single day, dumping. And what's interesting, if you look at some of the on-chain, or not on-chain indicators, but more of like the technical analysis indicators, we can see the lowest daily MACD in history. Now, what's interesting is it's the lowest MACD in history, but Bitcoin's only down 33% from its all-time high. Now, only 33%. What do I mean by that? Well, if you zoom out and look in this bull run that we've been on since about 2022, when Bitcoin was down in the about 16 to 20,000 range, this is the third pullback of about 30%. So 30% drawdowns in Bitcoin are kind of somewhat normal. In other bull runs that we've seen in the past, like in 2017, we saw 7 of them happen. And so while it's only down 33%, not 80 or 90%, the MACD is at the lowest point in history. We see RSI at 21. It's only been that low 4 times in 5 years. We're talking the COVID crash, the FTX collapse, but like we're nowhere near that, right? We don't have this macro shock going on. There's no credit event going on. And like I said, Bitcoin's only down 33%, which is sort of in line with it. And what I would say, we can talk about more, but what I would say is that when you see this forced selling, a fund is being forced, this distressed market makers being forced to unwind this position, I would look at the opposite and go, man, the market is absorbing that and scooping that up like a boss. For when the liquidity is coming back in, I think number one, I mean, we look at the Fed's ending QT December 1st and most likely starting QE again. I think that's really big. Number 2, we'll start to look at those rates coming back down. I think that's going to be really big. And then I think we'd continue to look at a lot of the spending that's happening as well. So keep an eye on all the major central banks. Keep an eye on those liquidity levels. We can see that in the U.S. specifically, sort of this liquidity levels have been dropping, as I said, because the government's been shut down, things like that. But I think all that's reversing. And yeah, I expect it to be pretty strong and pretty bullish through next year. I'm bullish on assets because I believe the governments will always have to print money. Now, to your point, there are some dangers that we see in the market. We can certainly hit some more liquidity pockets. We could certainly trip some more circuit breakers like we saw here. And we could see some selling, but I think any type of selling that we'll see in the market overall broadly will be swiftly met with more money printing and more stability. So I think any type of, maybe black swan or gray swan events that might trigger some liquidity crisis in a broad general market sell-off event, I think will be swiftly dealt with by the Fed. And so we'd see like this very rapid V-shaped recovery. in my opinion, it would be so fast, I'm not going to try to trade that position. Again, because I'm a little bit longer term, I'll look at that as a buying opportunity. But if I'm shorter term, then I might want to reduce my exposure in some of these areas where I see some risk, like the AI stuff. I might want to hedge some of my positions if that's the case for me. Even with this forced liquidation, somebody's buying all this up. And so you can see the wells, the amount of wallets that hold more than 1,000 Bitcoin are accelerating. You see some of the big funds that have been coming out, even Harvard, you can see that their buys are going up. And so the whales, what we call the smart money, they're buying the dip. I think this is a great time to add to your bags, to buy the dip. I'm certainly a buyer at this range. We know what the Fed needs to do. They're going to cut rates. They already told us they're going to cut rates. Again, personally, I think about this from a little bit of a longer term perspective. Trump has been very vocal. He wants rates down at 1%. He's told us that. He's told us that for a year. He's always been banging on the Fed to lower rates. Trump has a way of getting what Trump wants. Powell said they're going to lower rates. Not only are they going to lower rates, they're ending quantitative tightening. QT is ending December 1st. A lot of the Fed presidents are saying they'll start QE again, start buying assets again. And either way, Jerome Powell's out next year. Trump will replace him with a dove. And I'll make the prediction here. Before Trump leaves office, we'll probably see rates closer to the 1% number Trump wants. So that's very bullish. But where are we at, for this next meeting that's coming up here in a couple of weeks? Jerome's flying blind. Again, if you zoom out, I don't think it's that big of a deal in the big picture. Right now, we see that gold is still the main risk-off asset for central banks. We can see this sort of global regime change trying to de-dollarize, trying to get into a new system. China has been pushing gold. And so we can see there's this massive demand for gold, and I expect it to continue to go up at a really good rate. But I would say that maybe the demand drivers of Bitcoin and gold, while I might look at them as both this long-term risk-off asset, the market doesn't really see it that way. And so gold is still that risk-off asset, whereas Bitcoin, the market is still sort of pricing it like this risk trade. Now, we saw guidance from JP Morgan. They put out a report maybe a month ago, and they called it the debasement trade. And they put both Bitcoin and gold together, saying that both of them are going up because governments will never stop debasing the currency. They'll never stop printing money. So they showed that the mechanism for both Bitcoin and gold is the same, governments debasing their currency. But at the same time, the markets are sort of pricing those two assets differently, as we're seeing right now. So when there's liquidity crisis that's happening right now, to your point earlier, the markets, the Fed's flying blind from data, et cetera. In this risky environment's happening, Bitcoin's selling off while gold is going up. So the underlying long-term fundamental drivers per JP Morgan are the same, monetary debasement. But in the shorter term, the drivers are a little bit different.
To understand the trajectory forward, we must look beyond the immediate plumbing issues of the crypto market and focus on the liquidity cycle. The leverage flush, which wiped out nearly $20 billion in positions, was exacerbated by algorithmic auto-deleveraging, not a fundamental change in the asset. The macro backdrop remains decisively bullish. The Federal Reserve is scheduled to end quantitative tightening on December 1st, effectively pivoting toward a new cycle of quantitative easing. Furthermore, with political pressure mounting for interest rates to return closer to 1%, the cost of capital is set to decrease significantly. This aligns perfectly with JP Morgan's debasement trade thesis. Both gold and Bitcoin are fundamentally driven by monetary expansion. While gold is currently reacting as a risk-off asset and Bitcoin is temporarily held hostage by short-term leverage dynamics, their long-term drivers remain identical: the inevitable debasement of fiat currency.
The short-term price action is hostage to the market. I don't think it means that the asset is a hostage. So what are we talking about? Sort of what you said, it's a plumbing issue. So what happened, I think, is leading up to what really caused this to happen. We'll get into that, what FundStrat said. But since the ETFs went live on Bitcoin, we've seen the volatility collapse. In order to overcome that, what we've seen is that the trading has become over leveraged in Bitcoin and the crypto market overall. And so we've seen this massive buildup in leverage because that volatility has been lower and the complacency was high. So you sort of have that buildup. Then what happened is on October 10th, 10/10, Trump put out one of his tweets that likes to move the market, and he said he was going to slap 100% tariffs on China. Just like we saw in April, that sent the market reeling. The market started collapsing. And what happens, because one, we have the over leverage, as I already said. Number two, we have so much of this algorithmic trading going on. So as the market starts moving down, it starts sending a cascading event, and it created the largest liquidation event ever recorded. About $20 billion in leveraged positions were completely wiped out in less than 24 hours. It hit about 1.6 million accounts. And normally that would happen from, massive macro shocks, something like that. An exchange blew up, something like that. But that's not what happened. It was to the point that Tom Lee made, you brought up, a major market maker blew up. And so we've seen a couple of them that have actually blown up. Looks like Wintermute maybe went down. Maybe another exchange went down. He doesn't really want to name them. But we started seeing this liquidation. And what happens is you have something called ADL. It's automatic deleveraging. Mm-hmm. So what happens is as this liquidity starts to dry up, these accounts, looks like Binance being one of them, started to liquidate or close people's positions, even though they're in profit. So it closes positions indiscriminately, and it's taking the profitable trades and sort of socializing the losses, if you will. And that's exactly what we saw. We saw the other account, I think what maybe he didn't want to name them, but it looks like Stream Finance. That's a major delta neutral fund. They're about 200 million AUM. It literally blew up because of this ADL cascading. And so that seems to be what happened. What Saylor's really doing is pioneering something completely new, and most of us can't really understand what it is, because when new technology comes around, it gives us a new set of building blocks to build new things that we can't imagine. So we try to understand them by relating it to something that we can't understand. So for example, when electricity was first invented, the first killer app, the first use case was like a light bulb. So like, what is this electricity? I don't know. It's sort of like a digital candle. Okay, it was, but it's so much more. The internet, right? And when its first killer use case really was email. Oh, it's sort of like a way to send electronic messages, and maybe one day we'll buy stuff online. Sure, but we didn't really imagine this world that we have today, where everything like we're doing what we're doing now. Mm-hmm. And so what Saylor is doing is he's taking Bitcoin, which is the first new financial asset we've had in over 400 years. And what is it? Well, it's sort of like a digital gold, and it's sort of like a digital currency, and it's sort of like all these things, but it's something different. And he's coined the name digital capital. And now with MicroStrategy, he's creating digital credit on top of that. So you're taking Bitcoin, which has about a 50 vol, is a 50 vol asset, but not everybody wants to manage that volatility. Nobody wants to stomach that, wait 4 years, as we can see people on Twitter crying today about the 33% drawdown. Yeah. And so he's stripping the volatility and giving people certain preferred instruments at different yield ratings. So some of them are institutional grade, and some of them are junk bond level. So to your point, are they more like junk bonds? Some of them are designed to be more like junk bonds. So you can sort of decide where you want to get in. He has 4 preferreds out right now. Some are more like a stable coin, more like a money market account, and some are more like institutional grade with a convexity, with a convert on the upside. So I think I think there's a couple things going on. Number one, it's all of those things because there's 4 of them. Number two, the market really hasn't figured out what's going on. This is all really new. This is all just this year alone. And then number three, throwing the baby out with the bathwater. When Bitcoin starts to crash as it is now, MicroStrategy, the common stock goes down. And then of course, those preferreds are going to get dragged down with it. You have everybody online already talking about where's his liquidation price, and all of these talks from 2022 are being revived. So I think it's just the narrative. It's something new. People don't understand it. And it's sort of maybe to be expected this early in the game.
As we navigate this period of volatility, it is essential to recognize the evolution of the asset class. Entities like MicroStrategy are not just hoarding assets, they are pioneering digital capital and creating digital credit markets. By stripping out volatility and offering yield-bearing instruments, they are building the financial infrastructure for the next cycle. The data confirms that smart money understands this. We are seeing an acceleration in the number of wallets holding more than 1,000 Bitcoin. Institutions are buying the dip while the algorithms sell. The current distressed selling is temporary, but the liquidity injection from central banks is structural. For the astute investor, this disconnect offers a clear opportunity. We expect any further liquidity shocks to be met with swift monetary intervention, leading to a sharp recovery. Remain focused on the liquidity data, not the leverage noise.